Welcome to today's Explainer. We're jumping right into a highly debated, pretty controversial wealth building strategy today. We have to start right out of the gate with this famously blunt quote from the legendary investor Charlie Munger. The entire blueprint really leans into this harsh reality. I mean, for most of us, hitting that initial 100K mark, it feels like an absolute grind, right? It's this massive uphill battle where your progress just feels painfully slow. All right, kicking things off with Section 1, the first $100,000 hurdle. The core of this strategy is built entirely on what Brian calls the wealth explosion philosophy. The big idea here is that wealth doesn't just grow in a straight, predictable line forever. Actually, locking in that first $100,000 is framed as the mandatory ignition switch. Once you cross that specific threshold, the math completely shifts, and your net worth can theoretically start to compound exponentially. You'll notice this framework treats your savings like a literal mechanical machine, a compounding engine. It's the mathematical mechanism designed to multiply your initial capital over time. But, and this is the crucial turning point in the whole blueprint, it warns that there are invisible forces actively trying to stall this machine before you can even get it up to speed. Which brings us right into Section 2, the 2026 compound wall. Now, the author makes a rather bold claim here. The framework argues that leading up to 2026, a literal wall has been constructed by the IRS. So according to this philosophy, you aren't just dealing with bad luck or a volatile market, you are facing a deliberate structural barrier made up of hidden tax penalties. And these penalties are allegedly designed specifically to keep your net worth stuck, preventing you from ever hitting that explosive growth phase. The assertion from Brian the CPA is that this is absolutely no accident. Driven by that massive $39 trillion debt we talked about earlier, the argument goes that the government is essentially addicted to these fees. The blueprint even suggests that the mainstream financial news you see every day is basically just economic theater, a distraction meant to mask this harsh reality from new investors who are just trying to fire up their compounding engines. So how exactly is this wall supposedly trapping your money? Let's move to Section 3, invisible tax siphons. The claim here is that this wall isn't built out of massive, obvious tax hikes that make the front page of the news. No, instead it relies on sneaky, nickel and dime fees. It's essentially death by 1,000 cuts. We're talking about small, easily overlooked charges that drain your capital before it ever has the chance to multiply. The real danger, as highlighted in the text, is that these siphons bleed your wealth indefinitely, completely under your radar. Digging into the specifics, the strategy pinpoints two primary culprits that are stalling your progress. On one hand, you have sneaky underpayment penalties caused by poor settings on your W-4, your standard payroll tax form. And on the other hand, there's the massive danger of missing cost basis information on your 1099-B, which is the form used to report your investment sales. When you look at the mechanics, it's pretty clear how these two errors can completely derail you. Poor W-4 settings trigger payroll underpayment penalties that just quietly drain your cash reserves year after year. But those 1099-B errors, the blueprint frames those as even more destructive. Remember, cost basis is just what you originally paid for an investment, while the blueprint warns that if that info is missing, the IRS just assumes you paid $0 for it. That disastrously turns your entire hard-earned sale into pure taxable profit. It's a huge hit. And that really illustrates the real-world impact of Brian's argument. These hidden fees aren't just minor annoyances. They act as massive structural drains. They actively eat away at the pure capital you desperately need to hit that 100K mark. You end up being left with just a fraction of your wealth to actually fuel your growth. Alright, now that the problem has been fully outlined, let's explore the final phase of the blueprint. Section 4, building your financial fortress. To bypass this 2026 compound wall, the framework outlines 3 clear, very mechanical steps. Number 1, you absolutely must actively identify and plug those invisible siphons. So fix the W-4 and rigorously track your 1099-B basis. Number 2, aggressively utilize pre-tax buckets. And number 3, by combining those actions, you construct what the author calls a financial fortress to shield your wealth. A core piece of actionable advice for building this fortress is the strategic use of specific pre-tax buckets, and the blueprint heavily highlights health savings accounts, or HSAs, as a primary tool here. Because of their unique tax advantages, the strategy pushes you to use these accounts to legally shield your dollars from those invisible siphons. The goal is to ensure your capital goes straight into your own compounding engine and not to the IRS. Ultimately, this whole strategy boils down to what the framework calls protecting your legacy.
By plugging those administrative leaks and using those pre-tax buckets, the argument is that you can force the math back into your favor. You protect your capital from the 2026 compound wall, and you finally trigger that highly sought-after wealth explosion, turning the daily grind into exponential growth.
So I'll leave you with this pretty provocative question drawn straight from the core of the blueprint. As you sit down to review your own financial setup, look closely at the fees and taxes you're actually paying. Are your hard-earned dollars fueling an engine that builds your own legacy, or are they just being siphoned off to fund the wall that's keeping you from that first $100,000 hurdle? It is definitely something to seriously ponder. Thanks for joining us for this explainer, and we'll catch you next time.